Good afternoon. Welcome to the second half of this Introduce Day. My name is Oskar Wikström. I work as an equity analyst here at ABG. And this afternoon, we are listening to Johannes from Note, who will tell a bit more about his company and where they're headed. So I'll leave the word to you. Thank you.
Thank you. I don't know how many of you that knows what Note is doing, but Note is a company that are doing what is called contract electronic manufacturing. We are doing electronics and box build for other customers. So we don't own any products, we produce according to our customers' specifications. That's our business model. Currently we are 8 sites. We are present in 5 countries with our own manufacturing. We are, last year we were turning just below 1.4 billion Swedish. We are just over 1,000 employees, and we have a distribution where we are about 300 people in Sweden, 300 in China, a little less than that in Estonia, and then we have a small unit in Finland, and we have 2 units in UK. Sometimes I get questions, why do we have 3 sites in Sweden? But we think that footprint makes quite a lot of sense for us because we have different competences in the different units, and we have diversified our customer base to fit those sites. So if you take Lund and Torsby, for example, they are quite different in the setups, and we have different customers that choose the different sites depending on what competences we have. So in this industry, many people tend to think that we duplicate what we do in all the sites, but I'm a little bit on the other side. I think that all sites should be different. That adds value to us. If every site were the same, then you need to be very, very big. And if you look at the EMS industry, you can say that the company that put this industry on the map in Sweden was Flextronics in the late 90s, when they were acquiring sites from Ericsson, ABB, and others. They were a lot of doing this. They wanted to have the customer to feel at home every time they went into a Flex site. We think the customer should feel at home, but we should be different. We think that is a strength to us. We can come back to that a little bit later. But this is our company timeline. We were founded in 1999, and that is, I would say that is in the medium time frame when EMS industry was started. I would say that it started somewhere in the early 90s, and then it exploded with the outsourcing trend that were in the 90s. And at that time, all the companies like us, and some of you might have listened to Hansa earlier this day, we were acquiring customers' production units, and then we took over the production and we started to produce, and everyone was chasing more and more business because everyone knew that the customer may choose to leave. Normally, a carve-out contract is 3 to 4 years of production, and then the customer is free to do whatever they like. And that is one of the reasons why Flextronics had a very rapid growth in those days and very rapid decline when these contracts were ending, and all production was basically moving abroad at that time. So you can say at the time until from 99 until 2005, 2006, there were a lot of acquisitions and a lot of carve-outs. Then you can say that the industry went into some kind of, I would say, harmonization, and a lot of these carve-outs were actually closed. Note has been in that, how should I say, that wheel as well. We bought a lot of companies. We bought a lot of production units from customers, and then we have also closed most of them. So it has been some kind of closed loop from starting in the mid-90s until 2012, 2013. After that, I would say that the EMS industry has entered what I call some kind of maturity. So what you see now is what you get. We are happy with the footprint. All the sites makes a lot of sense. We have a good split between the customers in all our sites, and many of our competitors are quite similar to us. So today you can see that what we buy, for example, when we acquired Speedboard, this company makes a lot of sense. We know that the UK market is very interesting. It's fragmented. They like to do business within UK. So it makes a lot of sense for us to increase our presence there. So we don't buy it because we want to take the production, move it to our low-cost manufacturing sites. We buy it because we think it has a good value as a standalone company. So that's the strategy. And then we believe that we can also approach these customers to attract new business that we can move to our low-cost manufacturing sites. So today I would say that the market is, in some sense, quite mature. I don't foresee many of these carve-outs coming out any longer. There might be a few ones of them. We are always open to discuss that, but we see more that we acquire sites that add value to us from a broader perspective, meaning that if we add acquisitions, it should be an acquisition that we believe is strong and has a good standalone value. That's how we see it. But you can see here that we had a lot of sites that we acquired. We had at one time 5 or 6 places in Sweden, quite small every one, and we tried to have some NPI activities, and also we tried to drag production out of those units, move it to low-cost manufacturing sites, and keep the customer interfaces and stuff like that from the Swedish sites. But it became very complex, and it didn't add the value that the customers was prepared to pay for it. So profitability was low and complexity was high. So the current structure we have is that all our 8 units are P&L units. They are handling the customers by themselves. We have some how should I say, harmonized key account management for larger and global customers. But all customers that are local, they are handled locally, even if it's in China or Estonia. So that's the structure that we work from today. And it works, as we see it, quite well. So what do we do? I often say that we get questions, can you help us do the product design? And we always say no to that. We can guide our customers to companies that are specialized in that, but we don't want to get into designing our customers' products. We rather take the product when the design is relatively frozen, and we help them to do the industrial design. How should it work? Have they designed in complex procedures and complex components? Then we help them to design them out and design more producible designs. So we try to help the customers in the manufacturing design phase and in the industrialization phase to ensure that the product has good producibility. We often look into how can we improve yields, how can we ensure that the components that they choose have a long lifetime and so on. We don't want them to design in components with a very short timeline. Then we know we get into the ECO handling, and we know that the customers may have regulatory approvals and stuff like that, and then we know that it's a long procedure to change these designs. So that's what we do in the earlier phases. Then our core business is serial production. I know that some of my colleagues says that we are selling a service, but if you ask our customers, they say that we are selling production. So production is our service. So I often talk about how do we ensure that our production service is efficient and it stands up to our customers' requirements. That is the basis of what we do. So you can say that even if we have this big slide, we have 90% of our sales is coming out of the one square that's called serial production. Then we add all the services that are needed for the customers to have efficient serial production that we surround our business with. So that's how we work. And these lines you can say is basically, they're often shared services like sourcing, bill of material management, where you scrub booms, where you go into and see, okay, how we selected components that have a good availability on the market. Have they designed out all the sizes and stuff like that? We try to ensure that we don't need to do ECOs in the serial production phase because that costs money and it costs time. So that's what we try to do. Then we have some more specific things where we have lately entered quite heavily into the medtech field. We have added clean room capabilities in more sites, and we are adding more clean room capabilities in more sites. We think that the business goes into more and more complex production. We have especially our site in Torsby that are designed into handling components and products for rough environments. We do products for the mining industry. We do products for automotive and other areas where there's very hard requirements on the awareness of the products and the durability of the products. So we have this site is specified to handle these kind of products. So that's what I mean in the early phase, where we try to set up different sites to handle different customer segments. If we are adding all the capabilities in all sites, we will have hard to earn money on the less complex products. So if we have low complexity, we go to sites that are set up for handling that, and we have a different margin objective in that case. So we try to guide our customers to choose the right site for their specific products. What we do is that we look at in the upper chart here, we say this is how our customer look at our products. And we believe that we should be very strong in all phases, but the maturity phase is where they earn the money and where we want to earn our money. So we help them in the introduction phase to make that as short and smooth as possible, but we also help the customers in the after sales activities. We have several customers where we are handling all their spare part components, where we handle service on the customer's products and so on. So they send back the products to us, and we do the repair and the maintenance of the products. So we try to see ourselves as a one-stop shop in that respect. I don't like that word, but that's how we try to look at ourselves. And as I said before, we are 90% is production, 50% of the sales is pure PCBAs, and 40% is boxed electronics. And we can do semi-finished up to finished products. It depends a little bit. And we also do, for some customers, we're also handling their logistics. So we ship the products to their warehouses or their customers. It depends a little bit how the customer wants to see it. But we have the capabilities to do that. And some might think that this grows a lot. I would say that it's fairly stable. Often we do sub-assemblies, and the customers are doing the final assemblies, and then they want it to be shipped to their factories, and we ship to all their units instead. So it's a little bit depending on which segment you are, but the further you come into making a final product, the more likely it is that we also handle the distribution to the customer warehouses or the customer's customers. So we have that capability, and we do it in quite many instances. Our vision, it's very simple. We should add combining local presence, global reach with close interaction. But we also say we should be our customer's best partner. But what do we mean with that? It's not so much about words. What I have said is that we should be the number one in delivery performance in this industry. If you are that, you take away one of the biggest headaches that our customer has, that we are late with deliveries into their production or to their customers. So today we are running our sites with more than 95% delivery performance. We are often reaching 96 to 97% on first confirmed date. That is the highest in the industry. And we are driving this even higher because we know that this is one of the biggest concerns of our customers. We also work a lot with increasing our efficiency and increasing our quality performance within the sites. If we can be number one in delivery performance and number one in quality performance, then we know that we will be a natural choice for our customers to choose for the next generation and for adding more products to us. So we believe that being very, very good at our production, which is our service that we provide and which is our core in our industry, if we are there, we will always be the natural choice for our customers to choose. So that's how we have tried to build our vision into work. Our customer base, we're often perceived as being very heavy on the industrial segment. And that is quite true. We are about 60% are coming from industrial customers. But then again, industrial customers for us is a very, very broad area. So it's not that we are very single-minded and that we have one stream of income. In our industrial sector, we have customers like Trimble, we have customers like Delaval, Atlas Copco, ABB, and others. So it's a lot of big companies with very diversified product ranges. So we are not that dependent on one customer or one segment. So in my mind, the industrial segment is enormous. But we are also growing our other segments quite well. We have invested in our medtech facilities, and we are today ISO 13485 certified in 4 of our units, and we are probably adding 1 or 2 units during next year into the medtech sector. This is one way of increasing our competence. It's a good area to be in, but it's also customers are more dependent and more requiring more processes. So we need to be very smart in where we add this capability because it also costs money. But the good thing with medtech is that if you have a customer that are certifying the product, then they are very, very hard to move it, especially if they target the American market and they get FDA approvals, then we know that to move from us is going to be very, very tricky. So therefore, medtech is a segment that many of our competitors, together with us, are targeting. We also grow in our defense area. Defense in Sweden has come into some kind of upswing, and we see that also from our customers, that they are demanding more and more production from us. But we also put up high-end consumer. You can say, why do you have a segment with 2%? That's too little to show here. But it's those customers that are requiring the full logistic chain. So therefore, we add it here because we want to talk about it, that we have this capability. So I expect that the high-end consumer segment will grow. Maybe it's not going to be our biggest segment within the short time frame, but it's a very important segment because it adds one more service that other customers don't require. So therefore, I think it's important, and it's important that those customers also feel at home in our company. But if I look at this, I would expect that the industrial segment will probably decline in size over time. I expect medtech, high-end consumer to grow. I also expect defense to grow, but not that much because it's a quite narrow market. Communication and industrial will continue to be relatively big in their sizes, but lose a little bit over time. That would be my expectation. Then again, we see that we are winning quite nice industrial contracts, so we don't look bad upon those. So don't get me wrong here, but I would expect other segments to grow more because they are smaller in size. But otherwise, I think that we have a good mix here. And also the industrial segment is very, very diversified. So it's not 1 or 2 customers or 1 or 2 segments. It's huge and broad. Okay, our growth, we have 3 avenues: existing customers, new customers, and acquisitions. We say that we should grow 10% yearly. We are currently delivering over this number, so we expect that to continue. Acquisitions, we see that we should grow 10% organically, and acquisitions should come on top of that. That's what we are targeting internally. Our financial targets, we have talked about them growth. For me, anything below 10% is actually standing still because the industry is moving, so you need to grow to get the momentum. We need to have an organization that are used to growing, because if you're standing still and then you start to grow, then you start to add people in a lot of areas. If you grow every year, you have that in your DNA, and it becomes very, very easy. So we talk a lot about growth, and I think that we are currently adding that as a competence within the group to always grow and always strive for growth. So this is very important for us. Profitability. I often say we should be slightly better than our competitors, then we are quite well off. But the industry as such has over time started to come up in profitability. When I worked for Flextronics some 20 years ago, everyone thought that if we can earn 3%, we are very happy. Today we are much more ambitious than that. Our capital structure is very important for us. We should always keep a strong equity. And we also have a dividend policy where we strive to exchange some money out to our owners as well. So some numbers. This year we have had a quite good start, 28% growth. This should be read into 3 different areas. We have one area that we can't control, which is currency. 3% of the 28, give or take, is currency. Then the 25% that's left is about half is the Speedboard acquisition and half is our organic growth. Our profit, we are growing about the same as our sales in the gross profit, but on the net profit we are growing quite faster. This is also where we can utilize our infrastructure that we have with the factory structure that we have. So we expect more to come from that area. I often get questions, where are we heading? And if you look at these graphs that we are quite proud of, we are seeing that on the right graph here we see the growth quarter by quarter for the rolling 12 months per quarter. And we expect that to continue, part of it driven of course by the acquisition in November, but also with the high organic growth that we currently see. I get some questions, have we reached a plateau here or where do we go from here? We are also saying that we don't give out any guidance to where we are ending up, but we can say that we're 0.7% higher in our operating profit for the first half year compared to the first half year last year. And we are adding new customers that we have, where we have contracts that we have been awarded over the last 9 to 12 months that are currently going into production. So I will repeat what I said in the second quarter report, that we still believe that we have all the fundamentals in place to continue the growth in the same pace as we're doing. That's what we're still seeing.
All right, thank you very much. We also have time for a few questions. I would like to stay on the subject of growth and organic growth. Just in your opinion, this market, what is the market growing at? What sort of rate? And how are the competitive dynamics here? You mentioned it's maturing. What's your market share? What's your competitors' market share? Can you continue to take market share? And just how sustainable do you see this organic growth?
We can start with saying that NOTE may be 0.1% of the world market, so we have some possibility to gain market share if you put it from there. But the market is growing with 4 to 5% year over year. Then you can say, will 2019 be a year of 4 or 5%? It's very hard to say, but we believe that we still see that there's a quite good growth in the market. But we also see that since we have been quite successful in adding new customers, we have also seen that we are growing quite much faster than many of our competitors. So I would say that the industry is growing, driven by all the electronics and all the communication that we want to have in our lives. So we see that this is a good market to be in, and that we are managing to get the bigger part of that growth.
Understood. And in terms of this organic growth of 15% here, for example, how much is new customers of that? Or how much is existing?
I would say that it's basically half and half. Okay. And one thing that we should keep in mind is that organic growth with your existing customer, that is probably the best, the best view that our customer sees. If we can be good in retaining the next generation, if we are good at that, we know that the customers are approving our service. If they are not happy, they would choose someone else, because when you go to a new revision, that's when you have the biggest chance to choose another supplier. But as long as we have a good retention rate, as we look at it internally, then we know that the customers are giving us a good result in how we perform towards them. So I would say that half and half currently. Okay. I expect us to be a little higher on new customers in the coming quarters.
Sure. Okay, thank you. And one more question. I think we have time for one more. I was a bit curious. You showed that you want to basically provide most of the growth within the peak of the product life cycle. Yeah. But you also have some after sales, and after sales are usually pretty interesting to investors. And I was just wondering if you could just comment a bit, how much is after sales today, And what's the profitability of that compared to the more traditional production business?
I will answer it in this way, that the less volume manufacturing like it is, the higher the profitability is, or the higher margins you have. Then you have to work more with those kind of products to make the profitability, to retain the profitability, so to say. So I would say that our after sales are quite low in percentage. I don't have a number on it, so I will not guess and state something that I cannot commit to. But it's an important part, and we often see it as a service, but it's a profitable service.
All right, understood. I think we have to cut there, unfortunately. But thank you so much for coming.
Thank you.